Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. Today, we're putting a specific SGX listed company under the microscope for a deep dive analysis. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. If you're serious about uncovering the hidden gems and potential pitfalls in the Singapore market, you'll want to hear this and consider how our daily premium insights can give you an even sharper edge. Today, we're diving deep into Sheng Siong Group, ticker OV8. Here's what most investors get wrong about this supermarket giant. They think it's just another boring grocery stock with limited growth potential. But is that really the case? What if I told you that beneath the surface of selling vegetables and rice, there's a story of remarkable resilience, strategic expansion, and some concerning warning signs that could impact your investment returns? We're going to dissect 3 compelling reasons why Sheng Siong might deserve a spot in your portfolio. 3 red flags that should make you think twice. And finally, I'll give you my personal rating and strategic advice for how Singaporean investors should approach this stock. Let's start with the good news. First, Sheng Siong's financial performance continues to be impressive, especially considering the challenging economic environment. In the first quarter of 2025, the company delivered revenue growth of 7.1% year-on-year to 403 million Singapore dollars, while net profit climbed 6.1% to 38.5 million Singapore dollars. But here's what's really interesting. Their gross profit margin improved from 29.4% to 30.3%, which tells us they're not just growing, they're growing efficiently. In an inflationary environment where most retailers are struggling to maintain margins, Sheng Siong managed to optimize their sales mix and pass on costs effectively. This isn't luck, it's smart management. For Singaporean investors, this translates to a company that can protect your investment value even when economic headwinds are blowing strong. Looking at their full year 2024 results, revenue rose 4.5% year-on-year to 1.43 billion Singapore dollars, with net profit increasing 2.6% to 137.5 million Singapore dollars despite rising business costs. The company's gross profit margin improved to 30.5% from 30.0% in the previous year, demonstrating their ability to enhance their sales mix while combating rising operational expenses. The second major strength is their expansion strategy, which is both aggressive and well executed. Sheng Siong opened 6 new stores in 2024, bringing their total to 75 stores in Singapore plus 6 in China. What's particularly encouraging is that these new stores aren't just adding to their footprint, they're contributing meaningfully to revenue growth. The company's retail area expanded to over 661,000 square feet in Singapore alone. In the first quarter of 2025, they opened 2 additional stores and have secured 6 new store locations with results from 4 additional tenders pending. Think about this from a practical standpoint. Every new HDB estate needs a supermarket, and Sheng Siong has built strong relationships with the Housing Development Board to secure prime locations. This gives them a sustainable competitive advantage that's hard for competitors to replicate. Our premium members actually received early insights about Sheng Siong's expansion plans weeks before the official announcements, helping them position their investments ahead of the market reaction. This kind of forward-looking analysis is exactly what separates successful investors from the crowd. The third positive factor is their exceptional cash generation capability. Here's a number that should make any income-focused investor sit up and take notice. Sheng Siong generated substantial free cash flow in 2024, with cash generated from operating activities reaching 219 million Singapore dollars compared to 177.1 million in the previous year. This improvement was mainly due to better working capital management. What does this mean for you as an investor? It means the company isn't just reporting paper profits. They're generating real cash that can be returned to shareholders through dividends or reinvested for growth. Speaking of dividends, they proposed a final dividend of 3.20 cents per share for 2024, bringing the total dividend to 640 cents per share, representing a solid dividend yield. Now, let's flip the coin and examine the challenges. The first major concern is rising operational costs that are squeezing profitability. While Sheng Siong managed to grow revenue, their selling and distribution expenses increased by 13.3% year-on-year in the first quarter of 2025, rising to 65.8 million Singapore dollars. Administrative expenses also climbed 8.8% to 15.8 million Singapore dollars. This is a structural challenge that won't disappear overnight. Singapore's labor market remains tight, energy costs are volatile, and rental expenses for prime retail locations continue to climb. For investors, this means margin pressure could persist, potentially limiting the company's ability to deliver strong earnings growth even if revenue continues expanding. The second red flag is the increasingly competitive retail landscape in Singapore. While Sheng Siong has built a strong market position, they're facing intensifying competition from both traditional players like NTUC FairPrice and new entrants, including online grocery platforms and international retailers. The retail grocery business is inherently low margin, and any sustained price war could significantly impact profitability. Same-store sales growth moderated to just 0.1% year-on-year in the first quarter of 25, down from 1.4% growth in the second half of 2024, indicating that existing stores are facing pressure. The third concerning factor is their limited diversification and exposure to economic cycles. Sheng Siong is essentially a pure play on Singapore's domestic consumption, which makes them vulnerable to local economic downturns. While they have 6 stores in China, this represents a tiny fraction of their business. If Singapore enters a recession, or if consumer spending patterns shift significantly, perhaps due to changing demographics or lifestyle preferences, Sheng Siong has limited options to offset weakness in their core market. Additionally, their business model is relatively capital intensive, requiring continuous investment in new stores, renovations, and technology upgrades to stay competitive. Our premium members receive detailed sector analysis that helps them understand how these competitive dynamics might evolve, giving them a crucial edge in timing their investment decisions. So what's my personal verdict on Sheng Siong Group? After weighing all the factors, I'm giving this stock a hold rating with a slight positive bias. Here's my reasoning. Sheng Siong is a well-managed company with a strong market position and excellent cash generation capabilities. Their expansion strategy is sound, and they've demonstrated resilience in challenging operating conditions. However, the structural headwinds of rising costs and intense competition mean that spectacular growth is unlikely. For Singaporean investors, my strategy advice depends on your investment profile. If you're a conservative, income-focused investor looking for steady dividends and capital preservation, Sheng Siong fits well in your portfolio. The dividend yield is attractive in today's environment, and the company's defensive characteristics make it a reasonable hedge against economic uncertainty. Consider dollar cost averaging into the position over several months rather than making a large lump sum investment. For growth-oriented investors, I'd suggest treating Sheng Siong as a satellite holding rather than a core position. The stock is unlikely to deliver the kind of explosive returns that tech or healthcare companies might offer, but it provides stability and steady income that can balance a more aggressive portfolio. If you're investing through your CPF, the dividend yield and defensive nature make it suitable for the ordinary account, where capital preservation is important. From a timing perspective, I'd wait for any market weakness or company-specific concerns to create a better entry point. The stock has performed well recently, and patient investors who can wait for a pullback might find better risk-adjusted returns. So we've broken down Sheng Siong Group piece by piece, looking at its strengths and weaknesses, and I've given you my personal verdict and strategy advice. Now, if you found this level of in-depth actionable analysis truly valuable and want to seriously level up your investing game right here in Singapore, imagine getting daily premium insights delivered to you up to a week before anyone else sees them. That's what our members get for just $1 a month, less than a cup of coffee. You'll unlock a wealth of additional content, including daily market analysis, early insights into promising trends, and even deeper dives into specific investment strategies relevant to Singaporean investors, directly from my desk. Think of it as your consistent daily dose of financial fuel for smarter decisions. Ready to join the inner circle? Just click the link in the description below to become a member. If you enjoyed this deep dive analysis, I recommend checking out my upcoming podcast interview video on how to analyze SGX dividend stocks like a pro, where I break down the key metrics and ratios every Singaporean investor should know when evaluating income-generating stocks. Until next time, keep investing smart, and I'll see you in the next video.